with the big moves this week, a lot of investors could be trading with emotions and either getting in positions with no regardless price or getting out of positions because of fear of loss. And you need a plan so you don't have those emotions. And that plan consists of following the smart money. Right. We call it, the smart money is the banks, the institutions, the Buffetts, the ones that have the big dollars, right? Why is it so important to follow that smart money, and how can us as average investors potentially do that?
Yeah, well, you just hit on one reason. It's the big money. It's the money that they have to invest in these markets, to trade and invest. And they're very selfish about that money. They want to make sure that they make the most that they can from it, and that they lose the less or the least from it. And here's the bottom line, Josh. In the financial markets, the smart money, the pros, not only know how the markets work, they impact the markets in significant ways. And that's always to their advantage, and it's often to the detriment of the public. They're actually using your emotions against you. So instead of doing what they say, we want you to be able to do what they do, because they're giving us kind of clues as to what they're doing. They're kind of telegraphing their activities, but they're going to tell you something different, because the bottom line is that every trade, every investment has two sides to it. There's a buyer and there's a seller. If the pros are on one side, if they want to buy something, they're not going to buy it at a high price, which means that they have to find somebody willing to sell it to them at a high price, and that is typically the public. When they are ready to sell something, they're not going to sell it at a low price. They sell it at a high price, which means they have to find somebody willing to buy it at a high price. That's the public. So those are the things you don't want to do. And a plan that one of the great things about a plan is that it should result in you never having to ask, what do I do now? Because your plan's already going to have you planning ahead and knowing all of the potential outcomes and then how to respond to those outcomes. That's what's going to give you confidence. And there's three really critical components to every trade and investment. It's the proper entry, the proper stop, the proper target. This is going to have you knowing, why you bought where you bought, why you exited where you did if you were wrong to protect your principal, and why you chose the profit target to get out when you're right, and that's protecting your profit. Those are the three components that are important. And again, the plan that you utilize should have you prepared to take advantage of any of those things. And what we're seeing right now, Josh, is an entry into the market of millions of new traders with a huge amount of money, a huge amount of dollar inflows coming into the market from the retail traders, from the new retail traders, not necessarily from the institutions, because a lot of the institutions and the pros have been pulling money out of the market. So the people that are putting money in for the first time, they're putting money in basically at all-time highs in what appeared to them to be a market that couldn't stop going up. Mm-hmm. And we know that doesn't happen. The market, and it has gone up for a long time. And I can understand how some people can kind of get sucked into believing, hey, if anything happens, the Fed will come in and they'll prop up this market. They can only do that for so long. And inflation now may be one of those things that's going to keep them from doing that. So the question is everybody that has entered the market recently educated on how to react to different market conditions? Probably not. And do they know how important it is to understand it's not just how much you make, but even more importantly, it's how much you keep. And that gets down to risk management, and then also taking advantage of different market directions. The market can go three ways. It can go up, it can go down, it can go sideways. So far, most of the new participants in the market have been only participating in one direction. That's an up movement. And that's typically how Wall Street has you investing as one of their clients, is that buy strategy, and it's only participating in one out of three directions. That's one out of three odds. The pros don't do that. The pros, one of their rules is let's participate beneficially in all three directions. And there are tools that they use for different directions and different market conditions. But they're not any different than what you can use. They're just not being taught to you. That's one of the things that we do. We want to kind of even that playing field, teach our students how to utilize the same tools that the pros are using to benefit in any market direction, any market condition.
Yeah, imagine that, the smart money not telling the public the good things, right? It's always telling them what they want them to do. And the public is always, how does anybody trade? Anybody always says, "Oh, I buy low, sell high." But what does that really mean? I mean, I love to go to the Hy-Vee, right? Hy-Vee
Yes, you
grocery
do.
store. And, we go there, and if we're looking for a loaf of bread, I'm looking for a loaf of bread on sale. And my son doesn't go, "Hey, Dad, let's wait for it goes up to $4 and buy two instead." After it's gone up, you want a lower price, and that's the same thing in trading and investing. You were mentioning the retail investors, the public is buying at all-time highs. That's buying at a retail price.
Right.
So you want to be buying low, which is buying at a wholesale, selling at retail, just like those financial institutions do. But when Al's talking about that through those 3 points, the entry point, the stop, and the target. I mean, you could almost just call that target trading. That's where the computer will actually execute that for you. So you have your entry point, where you want to get in, your stop, basically your protection, and then your target. Where do you want to take your profits? Because eventually you have to take profits if you get them.
Well, eventually, but for a lot of people, it's after they retire. It's near the end of their life. If they're doing that buy and hold, it's something that you're supposed to hold on to for decades. And during those decades, you've missed out on all sorts of opportunities to increase your rate of return and to have maybe a retirement that is a little more enjoyable than somebody that didn't do that.
Yeah, and that's basically doing that without a plan if you don't have a plan to take your profits. Al, we always talk about the smart money, the big banks, the Buffetts, the Goldman Sachs, the JP Morgans, right? They are always profitable in the financial markets. And it's usually an exchange of capital from the people that don't know what they're doing to the people that do. And that's the retail versus the institutions or smart money. They also do that in more than just the stock market. So we want to trade like the smart money, which we want to trade like the smart money and the smart assets that they're utilizing. So let's talk about some of those other assets that they're using that are also available to the public, but you got to follow and understand how they do that.
Perfect. Let me start out though with this, because no matter what asset it is that we're talking about, it gets down to that proper price. And what we're looking for is a low risk entry point with a high profit potential, and also being able to protect our principal if we are wrong. What we find is that typically the best position that to take in a trade, whether you're getting in or out, is at the turn in price. And what causes price to turn? It's institutional imbalance between buyers and sellers. When there's an equal number of buyers and sellers, price isn't going to go anywhere. It just pretty well trends in a range. But when all of a sudden a big player like Goldman Sachs or Warren Buffett wants to take a position in something, and by the way, they don't take small positions. They're not going to buy 50 shares or 100 shares of Apple stock. They may buy a couple million shares. Warren Buffett once bought 64 million shares of IBM, $10 billion.
And when did he tell everybody he bought them?
Well, it was after he had already bought them. And the interesting thing is that he couldn't buy them all at one time. And this is really kind of what our core strategy uses to have this high degree of accuracy, is that we know that the big players that are putting a large position together cannot do it all at one time, and they can't exit a position all at one time. They have to do it incrementally to be able to protect their price, to protect their entry price, and to protect their profit. So we can take advantage of that because we can read that on a price chart. It's my brother just recently had surgery, and the doctor did not go into the room with him before his surgery, put the x-rays or the MRI in front of him and say, here, you figure out what this says. He had no idea, and most people, when they look at a price chart, probably feel the same way. Well, there are stories in every price chart. Everything you need to know is there. So the important thing is learning how to read a price chart. That is what we do. And once you learn how to do that, then you can identify those turning points, or you can identify a point where price will continue to go in a certain movement. What you want to do is be able to identify as accurately as possible the beginning of a trend and the end of a trend, and then participating in as much as possible the full movement of that trend. But you have to also know when it's over, when it looks like it's going to stop trending in a certain direction and change. That gives you the opportunity to be prepared and to take advantage of the new direction that's happening. And I mentioned earlier that one of the important things is to use a process that's simple, repeatable, and proven. Well, the process that our students use, part of that core strategy, is simple because you're using the same steps for everything you do, whether you're a short-term trader, long-term investor, regardless of what asset you're trading. It's that same set of steps, that same set of rules that not only control your emotions, but also will tell you whether this is a high-quality trade or actually with a trading platform our students have, Josh, it will even come up with an alert saying, don't do this trade. You're violating something that is specific to you. And then also, it has to be repeatable. If you're going to use something, and then you mentioned the word consistency before. The pros are consistent, and one of the reasons is because they really control the market. But you can be consistent if you're using something that happens on a repeatable basis. And basically, it's something that happens every day, and that's trading by the institutions. Mm-hmm. And then it should be a proven process. Well, this has been, the core strategy has been proven to have a high degree of accuracy because it was put together by guys that worked on Wall Street that actually were impacting that relationship between buyers and sellers. That whole strategy was put together based on that.
You're right. And the fact of the matter is you want to be able to find out, Al, the lowest risk, highest reward, and highest probability entry points into the market. And that is typically at or near that turn in price, which is where Al is talking about finding that imbalance of buyers and sellers. Just like think of it as an auctioneer. If price is, if they're selling I have a cell phone here. If I'm going to sell this phone, I say it's $5, I'm going to give it $5, I'm going to have 100 people bidding on it. So I have more demand for this one cell phone. Now I'm going to go to 500. There's still demand, 1,200. People know it's only a $1,000 phone, so they're not going to be bidding on it. So now I have more supply than demand. The price has to go down until I can find a buyer. And that's how the financial markets work. The concept is actually pretty simple.
Yeah, it's an irrefutable concept, too.
But you need the proper rules and you need proper tools to make those decisions. But where you find that information is on a price chart and understanding what are the tools and rules to read that price chart. Al, I think this segment goes by so fast, and we just didn't have enough time to talk about the difference in the leveraged assets. I want to get into that next. Futures, Forex, and options, and why the smart money is using that, how we can also use those. We will be right back.